When will the Fed recognize that this is not a soft landing? Welcome to the extended Real Vision Daily Briefing. My name is Andreas Steno, and I wish you a happy Friday. I hope that you will decide to spend the next 60 minutes in great company here on the channel as we unpack all of the central bank and market action for you together with my guest, George Gonsalves, the head of US macro strategy of MUFG Securities. George, it's a pleasure to host you at Real Vision. Good to see you.
Thanks for having me on, and thanks for pronouncing everything the right way. Many people don't know how to pronounce it. You're a true European, that's for sure.
And I know my Spanish. I guess that's why. The first 30 minutes, we'll spend some time on unpacking your framework around central banks, George, while we will take sort of a global tour around fixed income markets once we move to the Real Vision platform after the first 30 minutes. You can use the QR code, by the way, if you want to follow us to Real Vision after the first 30 minutes. So make sure to have all of your questions ready. We will try to answer as many as possible in the second half of the show. But George, I want to spend some time here initially on assessing your framework around central banks in light of this inflationary environment that we're amidst. And I want to use some examples from just the past week here to set the scene. One of the first things I've noted over the course of today is, of course, the news out of Japan. Suddenly a new headline with a new governor allegedly being in place for Bank of Japan from April and onwards, as far as I'm concerned. Earlier this week, we had another rumor of the Deputy Governor Amamiya taking over, but then suddenly the Prime Minister told us that it was a trial balloon that he was nominated in the press. So what do you make of today's announcement, quote unquote? Is it another trial balloon? Do we know at all?
No, I mean, look, we don't know. We'll find out more in the coming days. I mean, I think there's some idea that perhaps next week, the 14th, we'll get an official announcement. I think there was also some news headlines discussing that Amamiya-san potentially rejected the offer. We can't confirm or deny that, but either way, it was definitely a shock earlier on in the morning during London, late Tokyo, London hours, and into the U.S. Big move in the yen, and I think that as you know, and if you look at just like a very typical dove hawk charts of Japan central bankers, they're usually on the dovish side. So it's really about degrees of freedom between dovishness. And so when someone's neutral, as potentially the Yuda-san would be, that feels like hawkish, right? And the fact that markets had to go back. He's not a relatively known commodity. He was on the board many years ago, and at that time he was a little bit more hawkish, but that was given the circumstances of the environment back then. He's a professor, and so there's not much known about. But at the same time, perhaps this is an opportunity for Japan to start to pivot away too from ultra accommodative policy.
Indeed it is. But George, I want your take on whether it is common to sort of use these trial balloons in the press ahead of major nominations in central banks. Could something similar happen in the US once there are nominations for key roles?
Yeah, I would say so. I mean, even like back then, even back during the last few searches for the chair for the Fed, we had kind of just a very small select list of individuals that would be in the news. So I think this is nothing terribly unusual. I think it's really an attempt to find the right person. But at the same time, though, I mean, either one would have been, or we'll see who ends up ultimately being nominated. But this is really about understanding how to unpackage so many years of just accommodative policy and very specific facilities that were established. So having someone like Amamiya-san, would have been equally as important, even if he's viewed to be a little bit more dovish and would have perhaps adhere more towards the old Kuroda doctrine. Perhaps, we don't know, but at least he'll be able to know how all the plumbing works, because there's been so much put in place around all this easy money and facilities. And so again, Not to say that the new person won't either. We don't expect a like rip the band-aid moment where they just completely abandon YCC. As things are very typical in Japan, it's very methodical. There'll be a lot of consensus building around it, and I'm sure that whoever ends up being there, they know that YCC's expiration date is coming, and they're going to have to change it.
Mm. And we even have inflation in Japan now. World is upside down, George. And I want to talk to you about inflation in the context of central bank reaction functions.
Yeah.
Let's start with the Federal Reserve and how to view the inflation mandate within the Fed, because we've had a lot of discussions over the past couple of quarters on sort of the true target variable for inflation. Powell started talking about services X housing recently. So, what do you make of that discussion? What is the true target variable on inflation in the US right now?
Well, look, I would say because of the nature of how inflation evolved post-pandemic, they had to zoom in on a smaller, narrower set to try to at least isolate some of the noise around things. But at the same time, though, you have to kind of start to question all of this disinflation, disinflation. I mean, like repeating that too many times, gets the markets to kind of focus on that word, and it almost gives this like air that we've now beaten inflation, and that's dangerous in my opinion, and that's primarily in the goods sector, right? So the goods sector had a disproportionately large move relative to trend, up like 11-12% at the peak post-pandemic, and it's coming back down to earth, and it's probably got a lot more to go. I mean, we lived in a disinflationary world, as you know, and I know, pre COVID-19, when it came to actual physical goods, things got cheaper and cheaper over time, and we had just excess capacity. Now, it might be different going forward, considering the putting on changing the globalization and supply chains. That all adds frictions back into the picture. I mean, I'm much more open-minded now around the idea that the structural disinflationary periods probably are not completely gone, because we do have automation and technology much more so than we had in the prior great inflation of the 1970s. But nonetheless, I mean, I'm open-minded to the idea that these frictions may linger. They might reflare every so often, and that will change the central bank's reaction function on a go-forward basis. And having lived through 2/3 of the bond market's bull run of 40 years, being in the markets for 25 years, I mean, it's almost like against my grain of thinking. I'm like, wait, that doesn't make sense. Like we actually think rates can go up again from here. Like, so I think that, or stay elevated at least at a minimum. But I do think there is a lot more two-way risk here, and maybe rates will stay higher, but in a range, but not necessarily go to 8-10%, but stay at a higher range to discount for the inflation uncertainty that's going to linger.
Mm. If we look a bit ahead on inflation, George, you mentioned goods disinflation as a theme for the upcoming quarter or two, relative to this more sticky inflation that we see in the service basket, ex housing. Let's assume that we get this disinflation in goods, and service inflation will remain sticky. What do you make of that cocktail in the context of Fed's reaction function?
Yeah, I mean that really puts them in a tough situation. I think at that point, then the um, the trigger to change policy in either direction will come down to growth. And so if we're seeing sticky inflation and disinflation from one segment of the economy, but we're seeing growth hang in there, then the Fed really doesn't do anything. I mean, to be honest, that's kind of what the markets are now starting to price to. I mean, the rates markets have been skeptical and still remain skeptical, given how deeply inverted some parts of the curve still remain, even after this sell-off that we had in the last couple of weeks, especially this week, especially. But I do think that you end up with a situation where we get to an environment where growth will drive that decision. The worst case scenario, which I would agree, and I'm curious what you think as well. Like the worst case scenario is that the goods disinflation that we're banking on, which although carries a weight of 25%, but if it gets very close to zero, even maybe negative, right? Then what overcomes it? Like, what if you get a situation where let's say the China reopening is really going really well. We can discuss that separately, but just making that assumption, like the second half of the year could end up with a stagflationary environment where you get a whiff of energy inflation and commodity inflation. The goods deflation is not enough, or disinflation is not enough, and wages are still sticky, but yet growth is decelerating. That's like stagflation light. Then central banks can't ease, and like markets will not like that. I mean, markets are really hoping that that we get enough weakness or inflation goes low enough that the central banks decide to unwind some of this tightness. Like the worst case scenario really is a stagflation environment in the second half.
And we even see a few components of the goods basket now increasing in price again, which may be an early hint of that scenario that you just painted for us, George. So it will indeed be interesting to watch this cocktail of inflation versus disinflation across the basket over the next couple of months. We obviously have the next report coming out mid next week, so we will get more information already soon on US inflation. In relation to energy prices, you briefly mentioned energy prices as a sort of a dark horse in this equation as well. In Europe, where I live, it's actually seems as if the European Central Bank started caring about energy prices. They were simply forced to care about them throughout the autumn due to this material spike that we saw in natural gas, for example, in Europe. Do you think the Fed cares about the price at the pump in its reaction function by now, or is it more a question of wages and service inflation?
So if you recall back, and I'm sure you do, in June of 2008, when Bernanke also like got a little bit nervous about oil going to 140 back in that environment right before the financial crisis. And I'm not saying that that's going to happen again, but my point is that even back then they let their guard down and they got nervous about, look, energy inflation has the risk of really spilling into the economy quickly if oil were to stay at 140. Of course, it went down to 30, and if the rest is history. And so you never really had that pass through of higher inflation uh, from that, the knee jerk reaction. I guess it depends on how fast and what, and if it's remains elevated. If we get a situation where, because of refining capacity issues that still remain, by the way, if we have let's say that I'm much more bearish on the outlook for the economy, but let's say we don't get a recession or a weak environment, and then you have another kind of leg higher in activity, then U.S. will start to consume more energy. I mean, that's just naturally the way it goes. Then you have the summer period, and then you have China also on top of that. And Europe, at some point, although they were spared this year with winter, next year winter is coming again. It happens every year, and we don't know the outcome of that. And it's going to be at a time where Europe is going to be competing with LNG with China. I mean, it could literally really create a really big inflationary environment. And I think that at that point, I think the Fed would care. If it's not just isolated, if it's broad, and if it's persistent, I think they would care.
Mm. One thing that is noteworthy in this discussion on energy is the base effects that we measure energy against in February and March, not least due to the invasion spike that we saw in energy prices just after Putin rolled into Ukraine. So it will be very difficult for energy to sort of beat last year's effects
Yes.
over the next couple of months. But into the second half of the year, it is clearly a dark horse for the inflation outlook. And we obviously got news today out of Russia, news that they plan on retaliating against these Western sanctions on oil by limiting the supply as of March by, I think it was 500,000 barrels a day. So negative supply news, and who knows whether energy will turn up as the inflationary dark horse again in the second half of the year. George, in relation to this discussion on inflation and the reaction function from central banks, I'd like your take on whether we can trust the curvature of the yield curve right now as a predictor of the economic growth ahead. It's been an ongoing discussion since QE started, whether QE sort of manipulated the signal in the yield curve. What do you make of that discussion? Can we actually trust this current inversion to be a recession signal?
I still think we can, especially because every basically the whole term structure in one shape or another is inverted. So just the preponderance of almost every single relationship, depending on whatever pair of tenors you pick, they're basically all upside down, and really just a real demand for duration. Perhaps there's really a demand for duration for actual either regulatory reasons, and maybe that's skewing the information ratio and the value of what the signal tells us. But the fact that the whole curve is inverted, I still believe has some predictive power. I mean, what might end up being different this time is that because uh, it might just take longer. I mean, there's no guarantee that it's going to be 12 months, 18 months. Is it 6 months, right? I mean, in the past, the average somewhere around like the more towards the end of that period. But because of all the lingering liquidity, fiscal stimulus, people still burning down cash, it might just take longer for the recession to show up. But as long as we have an inverted curve all throughout this period, if it disinverts, then we can say, hey, look, that was a false positive. If the curve disinverts, but to disinvert this curve, especially with the back end, I mean, look, you can go back to the 2004, 2006 hiking cycle, right? The Fed also got rates up to 5.25. And right when they got to 5.25 for 14 months, they were on hold. I mean, that's a long hold period. And but the 10-year and the 2-year didn't believe them. Like literally, they all like even back then, even before the financial crisis, even before all of this, like even back then, people were saying, "Oh, the curve is wrong. The curve is wrong. The curve is wrong. What does the curve know?" And the curve just knew that there was some lingering concern about just the nature of the financial architecture. And the curve now is looking up and is concerned about both central banks' reaction functions. Are they going too far? Is there going to be fiscal support when you really need it? The catalyst may have changed, but at the end of the day, I still think that the bond market is, I've said it, and others have said it as well, is probably the best economist on the street, right? I mean, I think that they, except for last year. I mean, last year, obviously, we got it wrong, or at least the collective bond market didn't really see how aggressive central banks were going to be. But once we get to these elevated levels, around 4 to 5%, I think that it becomes a tug of war between the bond market and central banks. Because then, like, yeah, they can push it to 8% if they want, but they know they're going to break something. So we know that, they know that. But when it comes to this kind of like a level of rates, I think I think there's enough merit to believe that the bond market is telling you something. It's not to say that I don't think rates can go higher. I actually do think there is one potential last move higher in rates, and it might end up being a great buying opportunity. I wouldn't chase rallies yet because we don't know if the Fed's done and QT is still working in the background. But by and large, I think the signal is still valid.
Mm. If we assess whether the Federal Reserve members will care about this curve inversion, what do you make of that discussion? I mean, it seems as if Powell is just moving the needle on this curve inversion debate all the time.
Look, we can talk about just latest Fed sentiment or Fed speeches and how they've been conveying things. And I'm actually really looking forward to the February 22nd Fed minutes because it feels like there's some tension. And you can tell by the way that Chair Powell is trying to act super neutral. But deep down inside, I don't think he is neutral. I think he realizes he has a mission to complete. And if it requires insurance tightening and it might tip us into some sort of recession, I think deep down inside, I think they'll tolerate that because they know they can cut rates really fast if they need to, if it's a really deeper recession and if inflation were to be under control. I think there's a little bit of tension and maybe at the committee level, and we're going to hear more, perhaps not like a full-blown dissension, but that can also happen, by the way, down the road, right? But for now, it does feel like there's some tension around maybe, the doves, which turned into hawks over the course of the last year. Perhaps they're getting nervous about the outlook. But a lot of this also, by the way, happened before that monster NFP, which again is debatable. How strong is it really? But overall, the employment picture is good enough for the Fed not to be squeamish and to be fearful, and they actually should be pressing into this because the risk is they get it wrong and they have to reaccelerate hikes, right? The last thing they want to do is get to 5% and then they realize and they're on hold for 6 months and they're like, oh no, we got to go another 100. Like that would just be the hardest thing to pull off, right? I mean, like I don't think they want to do that, right? So they probably just stay on hold even longer and try to tweak QT and not redo another tightening cycle. So I think you're going to hear some dissensions, and I think that like what the yield curve. I mean, I think that are they ignoring the yield curve? Are they just hoping for the best? I think there's probably some of that, right? I mean, they've ignored the yield curve every single time. And now, even their own version of the yield curve, that 18-month, 3-month rate spread, also has the same characteristics. And so if none of these signals matter, then why do we look at them?
Yeah. By the way, George, what on earth happened to Neil Kaskari over the past couple of years? I mean, he went from being almost Bank of Japan-like in his rhetoric to now being the most hawkish member of the board, more or less. That's just one example of that tension.
Yeah, it is interesting, right? I mean, so look, I think like deep down inside, like just kind of understanding and reading a lot of the papers that Neil has. I mean, he's definitely like focused on the general population, and if people are people are getting hurt with higher inflation. I mean, I think he's viewing it from more that angle that let's get this resolved. I don't think like once it's fixed and then we actually have proof that inflation is sitting around 2%, I think Neil goes back to a dove very quickly.
Yeah, fair point. One thing that we haven't touched a whole lot upon yet is the outlook for liquidity and how we actually measure liquidity in this QE era. And I know that you are completely on top of these trends in dollar markets, George. So first of all, what's your definition of, say, excess liquidity in the banking system, and how do we actually track it?
So, I mean, look, you can think about it simply, and those that have looked at the Fed balance sheet, uh, there's only so many different categories, right? I mean, currency and circulation is going to be doing its own thing, and it's basically on cruise control based on the demand for actual money. And then there's reserve balances, the Treasury general account, and the reverse repo program, right? So
Hmm.
those are the three big buckets. And those buckets all have to tee up and tie up to match the other side, which is the asset side, right? So the liability of the Fed's balance sheet is really the big liquidity, right? However, there is bank, the shadow bank system liquidity, which is also out there, and that's the repo market. That's the need for collateral. That is just marginal lending and just activity that's a lot of it not going through the banking system, so you can't even see it, right? So I think the combination of the pure bank, which ties back to the monetary base with the Fed's balance sheet, and then you have this non-bank liquidity, which is also super important too. And it's becoming, I mean, look, it's not the same sort of market like it was pre 2008, but it's still pretty big. I mean, and it's been growing, and it's different providers of liquidity, and they're not under the purview of the Fed. But just like I do think that that could be like a whole other topic that we can spend
Hmm.
many hours going through. But just like when I look at it at the surface to see where there's spillover into the public markets and the financial markets, I truly do care about the interplay between the Treasury's general account, the reverse repo, and the reserves.
Hmm.
And right now, the Fed has the double tightening of not only just raising rates and targeting the price of money, they're also targeting the quantity of money, and that matters, right?
Hmm.
So if we have QT, QT is slowly chipping away at the balance sheet, taking it down in size. But then you have the ebbs and flows of what happens with money market funds, with their usage of the RRP, and then the Treasury general account, which, as I know you know, and you guys are, I'm sure, aware of what's happening with the debt ceiling and the need to operate within a certain limit. It could create some pretty big splashes in liquidity as money leaves from one bucket to the other bucket. And since money is fungible and it could be used for posting of collateral, for derivative trades, for and also just people can choose to asset allocate into different assets, and it's always that marginal dollar that could change the price of something. So if you're buying a bond at 100, and then you sell to somebody else for 105, you've created $5 of money, and that will then restock the whole bond market by 5%. So it lifts the whole thing up, and now you've technically created additional liquidity and money. So I do think that this what's happening now with the reserve balances is very fascinating, especially as we head into this the deadline for the debt ceiling and how that's going to impact flow. And I think it's already been having an influence, quite frankly. And I'm both curious about going into the debt ceiling and then coming out, because I think people sometimes forget about this. They ignore it because we've spent so much time over analyzing the debt ceiling that it's really the liquidity part that matters, not necessarily the credit risk.
Mm. And I want to unpack all of the details around these various buckets of liquidity in the second half of the show on the Real Vision platform in just 5-6 minutes from now. But the final question I have for you on liquidity here in the first half of the show, George, is whether it is trickier for a central bank like the Fed to control risk sentiment given these excesses in liquidity happening from time to time due to liquidity spilling over from one bucket to another.
Yeah, that's a great question. And I think that it could be why they've been having a hard time answering financial conditions are easing or
Mm.
not easing, because at one moment it could be a lot of easing, and then they can tighten up very quickly, and it's out of their control, as much as they don't want to admit it. So I think it is a challenge. I don't think it stops them from doing the traditional hiking of rates, because that's what they really have moved towards. We really care about using our main lever, which is the rate channel, and that's the part that it's easier to communicate to the public. What are we doing with rates? The whole balance sheet is a mystery, and they've sometimes themselves have admitted we don't really know how it fully works through the banking system. So, I mean, I don't know if I believe that completely, but I do think that, there is a lot of unintended consequences, which makes it challenging for them to, understand where we are at a given point. But yeah, we could talk more about like what this means in a higher rate environment, because my real contention and concern about this is that when we've had these mini flare-ups in the past, it's when rates were at zero, so the opportunity cost was very low. Now,
Mm.
when you have rates really high, the margin for error is not the same.
Mm. Absolutely fair point, George. Um, One thing that we actually haven't touched upon yet is the unemployment rate. And we asked the question initially, when will the Fed actually recognize that this is not a soft landing? And I guess that could be linked to the labor market, that question. I want to play a soundbite for you from a discussion between Roger Hurst and Damian Horner from Real Vision platform just earlier this week on this exact question on when will the labor market actually deteriorate. So let's listen to Roger and get back to that discussion.
What's been really interesting is that we've seen what was very much a consensus of 2023 being it's going to be a recession, and probably either a deep recession or at best, a common or garden mild recession, but with a lot of downside. That narrative has clearly shifted away from the deep recession towards mild recession or even no recession. And there's a lot of people now moving into that no recession camp.
And is this a global thing, or is this just the States, or?
It's a global thing.
Right.
And it's a global thing, and it's probably because we have seen one or two parts of a normal recession that have just not happened yet.
Right.
And most particularly that's the employment scenario, or employment situation, which is notoriously hard. And this is why it's such a difficult thing, because unemployment or employment is lagging, it's prone to revisions. And normally when you get the sort of levels of unemployment that say that's recession, you're normally looking in the back rear view mirror. It's normally sort of data from 12 months ago that you're only getting 12 months down the line. But one thing that we can say with certain certainty is that in the US, since the 1940s, every single recession has come with significantly higher unemployment.
Yeah.
And yet, as we talk right now on the 6th of February, the unemployment rate in the US, which is a slightly dubious one compared to other countries because of the way the numbers are worked out, but it has fallen to 3.4%. So it's one of the tightest in about 50 years.
The entire discussion between Roger Hurst and Damian Horner is already available at the Real Vision platform for our Plus subscribers. George, the labor market is sort of the missing link in this recession talk. Do you see any signs of weakening out there?
Under the surface, there is some weakness, right? I mean, we can rattle off a whole list of things, but people are going to ignore it because they saw the 517,000 NFP and they saw the 3.4 unemployment. And what we have to remind everyone is it's usually the best before, it gets worse. I mean, that's the unfortunate true nature of the sort of economies that we live in. The unemployment rate at the lows means that there's only one way to go, is up if we ever do go into a recession. The idea that we stay at lows for long periods of time usually doesn't typically happen. Look at temp workers coming getting no longer reassigned. If you look at the nature of the job mix, a lot of it's low-paying jobs versus high-paying jobs, part-time jobs. We've had very little full-time employment increases in the last couple of months, and so I think we're seeing a unfair representation of like how strong the jobs market really is, and it's really happening at the blue collar, lower income type job levels, which those people are coming back to work after being offline, a lot of them due to COVID. I don't think that's really where the problem is. I think it's really, as some have called it, the white collar recession that eventually becomes a blue collar recession or a lower income job recession, because when people start cutting back spending, they're going to cut back services as well.
Mm. This was the first half of the Real Vision daily briefing. In the second half of the show, we will move the discussion to realvision.com. So it's just for Real Vision members. If you don't want to miss it, you can use the link in the description to join us on Real Vision in just a few seconds, where we will elaborate on liquidity trends and when the Fed will actually acknowledge that this is not a soft landing. So please join us on realvision.com if you want to get all the details around the liquidity outlook and the ramifications for global markets.